The price on your screen is lying to you, because the number everyone watches every day isn't the price people are actually paying. On paper, silver and gold look liquid, cheap, and endlessly available. In reality, the market is splitting in two, and most people don't realize which side they're on. Here's the contradiction. The world price is built on paper contracts, where hundreds of ounces are traded for every ounce that actually exists. But when someone tries to buy real metal, that price suddenly stops working. Dealers ignore it. Premiums explode, inventory disappears. And this matters to you for one reason. If you're making decisions based on a price that no longer clears real supply, you're exposed. You might think you own value until you try to turn it into something tangible. But here's the part nobody says out loud. When a market stops discovering price, it's not broken. It's transitioning. One game continues on screens, a different game begins in the physical world, and once you see where that split leads, you'll understand why the next phase won't be optional. What's happening here isn't a single spike, a shortage, or a temporary dislocation. It's a pattern that's been forming quietly, then all at once. The official price still moves every second, flashing across screens as if it represents a living market. But underneath that motion, the physical side has started to behave very differently. Here's what we actually see. Paper silver trades at massive volume with leverage stacked on top of leverage. At the same time, physical coins and bars don't move unless someone is willing to pay far above that number. Dealers aren't arbitraging the gap, they're stepping back. Some simply stop quoting. Others sell only what they already have, knowing they may not be able to replace it. This isn't random stress. It's what happens when a pricing system keeps signaling abundance while the real-world inventory says scarcity. Notice what's missing here. There's no panic headline, no official announcement, just a quiet refusal by the physical market to obey the paper signal. So here's the question that reframes everything. If two prices exist at the same time, which one do you think survives when pressure increases? Because this is where the story stops being theoretical and starts leaving evidence behind. The claim sounds extreme, but the behavior proves it. The futures price no longer clears the physical market, and you can see it in one simple detail. For every ounce of silver that's actually produced, hundreds of paper ounces trade against it. That ratio alone tells you this isn't normal price discovery. It's leverage pretending to be supply. Here's what that means in practice. The paper price can drop sharply, even violently, and nothing changes on the ground. Coins don't suddenly appear, bars don't flood back into circulation. Instead, the opposite happens. Sellers pull back, buyers rush forward, and premiums stay elevated even as the screen says prices are down. That contradiction is the evidence. If price reflected supply and demand, falling prices would unlock inventory, but that's not what's happening. Physical holders aren't responding to paper moves because they no longer trust the signal. They're setting their own price or choosing not to sell at all. Now notice what's missing. There's no mechanism forcing physical metal back into the system. No incentive strong enough to make real holders part with it. The futures market can settle in cash, roll contracts, or reset leverage. The physical market can only do one thing: deliver metal or refuse. And that refusal is where the pressure starts to build. Once that refusal sets in, the situation doesn't stabilize. It escalates, because the system wasn't built for a world where physical supply stops responding to price. It was built on the assumption that higher prices always bring out sellers. That assumption is now failing. You can see this before, not in charts but in behavior. In past moments of stress, paper markets kept trading while the real thing quietly vanished. The screen stayed calm. The supply chain didn't. What should have been a temporary premium slowly became permanent. What should have been a warning became normal. Now watch how fast this normalizes. Dealers stop promising delivery dates. Wholesalers tighten bids. Certain products simply stop showing up, and nobody rings an alarm bell because on paper nothing is wrong. The price still moves. The contract's still clear. But here's why that detail changes everything. When scarcity becomes routine, the market stops reacting to shocks the way it used to. Shortages aren't news anymore, they're assumed. And once that mindset takes hold, every new disruption hits harder because there's no buffer left. This is how a market drifts from stress into something more permanent. And the next layer exposes why the pressure isn't easing, it's being redirected. The next layer is more unsettling because it exposes a contradiction that can't be smoothed over. On one side, demand for silver keeps expanding across coins, bars, and strategic uses. On the other, a growing portion of the supply can no longer move through the system at all. Here's what's happening. Large volumes of silver exist, but not in the form the system can easily process. Alloyed silver, older coins, sterling, mixed scrap, starts piling up, wholesalers sit on it, dealers try to move it, and refineries increasingly refuse it, not because it's worthless, but because they can't afford to deal with it. This is where the story flips. The problem isn't lack of silver. It's lack of capacity to turn certain silver into something usable. Pure .999 metal moves. Everything else stalls. So wholesalers cap their prices or stop bidding altogether, even as spot prices rise. Notice the contradiction. The market claims silver is abundant, yet refuses to buy it. That tells you the issue isn't value, it's flow. When metal can't be processed, it effectively disappears from the market. Once you see that, it permanently changes how you look at shortages. Because the bottleneck isn't at the mine, it's inside the system itself. Then everything starts stacking at once, not slowly, fast. Refining capacity tightens, chemical inputs become harder to source, wholesalers pull back even more aggressively, and products that used to circulate freely just stop moving. Here's the pressure point. Refiners prioritize only what can be processed quickly. Pure inputs go through. Anything complex gets pushed aside. That decision ripples outward. Dealers can't offload inventory. Wholesalers cap bids to protect themselves. Retail availability shrinks again. Now watch how quickly this compounds. As refining slows, fewer bars come out. As fewer bars come out, fewer dealers can restock. As restocking fails, premiums stop reacting to paper price moves altogether. The system loses elasticity. This isn't one failure, it's several small ones hitting at the same time. And none of them reverse easily. You can't flip a switch and add refining capacity. You can't instantly reroute industrial inputs. You can't force holders to sell. So the market does the only thing it can. It tightens, quietly, relentlessly. And the real question becomes unavoidable. At this point, the story stops being abstract and starts touching everyday life. Because when systems fail quietly, the effects don't show up in headlines. They show up in your choices. You feel it when buying stops being simple. When a coin that used to be available anytime suddenly isn't. When the price on the screen says one thing, but the number you're asked to pay says another. When selling feels risky because you're not sure you could ever replace what you let go. For ordinary people, this isn't about speculation. It's about control. Physical metal doesn't rely on an app, a bank, or a promise. And that's why more buyers are entering now, not chasing gains, but escaping fragility. Access matters more than upside. Here's the subtle shift. People stop asking, is this a good price? And start asking, will this still be there later? That's a very different mindset. And once it takes hold, selling pressure evaporates. If this feels familiar, if you've noticed systems getting tighter, slower, more restrictive, say so in the comments. Because what's happening here isn't emotional, it's mechanical. And the next part explains why this keeps repeating, no matter who's in charge. What makes this unsettling isn't panic, it's how rational the system behaves while producing irrational outcomes. No one actor has to break the market, they just follow incentives. Paper markets reward leverage, speed, and settlement without delivery. Physical markets reward patience and refusal. Refineries optimize for throughput, not balance. Wholesalers manage downside risk, not market health. Each decision makes sense on its own. Together, they lock the system. Here's the mechanism. When leverage dominates price discovery, real supply stops being the signal. When real supply stops being the signal, scarcity can grow without raising alarms. And when scarcity grows quietly, those closest to the metal adjust first. Everyone else reacts later. This is why mainstream coverage misses it. Screens still move, contracts still trade, nothing looks broken, but the system has shifted from serving users to protecting itself. Risk gets pushed downward, liquidity becomes conditional, access becomes power. And here's the uncomfortable insight. Once a system starts prioritizing optics over function, it doesn't correct itself. It tightens until something external forces a reset, not because of conspiracy, but because incentives leave no other path. That's why what comes next won't arrive as a surprise. It will arrive as momentum. From here, the path splits, but neither direction leads back to the old normal. One path looks calm on the surface. Paper prices stay controlled. Volatility gets managed. Headlines talk about stabilization. But underneath, physical supply keeps thinning. Availability becomes selective. Only certain products move. Only certain buyers get filled. The market functions, but only for those already inside. The other path is louder. A disruption hits, geopolitical, industrial, or financial, and the gap can't be hidden anymore. Premiums surge, delivery timelines stretch, selling becomes difficult, not because demand disappears, but because nothing replaces what leaves. The price doesn't explode first. Access disappears first. Notice the uncertainty. Both paths can exist at the same time. Paper markets drifting sideways while physical markets lock up. That's what makes this moment unstable. Pressure doesn't release evenly. It migrates. And here's the key detail. Once a market starts rationing quietly, the next move is never announced. It just happens. A dealer stops quoting, a product vanishes, a rule changes overnight. By the time it's obvious, the decision window has already narrowed. The mistake is thinking this story is about price. It isn't. It's about access. When a system runs on promises, the moment those promises lose credibility, value doesn't vanish, it relocates away from screens, away from abstractions, into things that can't be delayed, diluted, or denied. That's the thread running through everything you've just seen. A market that still looks functional but behaves defensively. A price that still updates but no longer clears reality. And a growing divide between what can be traded and what can actually be obtained. This isn't the end of the system. It's a transition inside it. And those transitions don't announce themselves. They reward the people who notice early and punish the ones who wait for confirmation. Because the next phase of this story won't be about silver or gold specifically. It will be about which systems still work when trust thins out. If you want to stay ahead of that curve, follow for the next layer of analysis.